Hi, I'm Joe Follico, Principal Futures Broker at Insignia Futures and Options. Today I will explain one of the key advantages of investing in commodity futures, so don't go away. One of the most significant advantages of trading commodity futures is leverage. Leverage allows a futures trader to control a particular commodity with usually less than 10% capital of that commodity's overall contract value. For example, if you're an investor interested in trading a major stock index such as the NASDAQ 100, you could trade the Micro E-mini NASDAQ 100 futures contract. This contract represents 2 times the value of the NASDAQ 100 index. This means that one contract would have a total value of $32,000 if the NASDAQ 100 index were to be trading at $16,000. Now here's where leverage comes into play. You're not going to need $32,000 to trade one of these futures contracts. You're not even going to need $10,000. You're only going to need $1,870. That's right, only $1,870 to control $32,000 of the NASDAQ 100 stock index. That's less than 6% of this contract's overall market value. The amount of capital required to trade a futures contract is known as the margin requirement. Consider the margin requirement as a performance bond, the amount of funds you need to have available in your trading account to trade a particular futures commodity contract. Margin, when trading futures, does not refer to a loan, such as it does when trading stocks. Now let's look at another popular commodity, crude oil. If crude oil futures are trading at $69 per barrel, the total value of one contract would be $69,000. That's because one crude oil futures contract represents 1,000 barrels of oil. The capital required, or margin requirement, for one crude oil contract is currently $5,610. Based upon this amount, an investor is only required to put up approximately 8% of the contract's total market value to trade it. I hope you're finding this video informative. Please take a moment to click the subscribe button and give a thumbs up below if you'd like to see more videos like these. Now I will tell you how to trade futures with even greater leverage, day trading. Day trading, as opposed to position trading, enables you to trade with greater reduced margin requirements or even less capital. Day trading simply means you need to exit all of your trades entered in a single trading session before that day's market closing time. Day trading allows an investor to trade futures contracts at margin levels typically 75% less than a contract's full margin requirement. Looking at crude oil again, the current day trade margin requirement to trade one contract is only $1,471. That's 75% less than the full $5,610 margin requirement for position trading. Likewise, the day trade margin for one Micro E-mini NASDAQ 100 contract is currently only $468. Now think about what I just said. You're controlling $32,000 of the NASDAQ 100 stock index for only $468. As you can see, day traders greatly benefit from leverage and can trade with even less capital. Either way, position traders and day traders could all take advantage of the power of leverage. You could trade many commodity futures markets, such as the NASDAQ 100 index, crude oil, gold, soybeans, coffee, and more. There are many futures contracts available to choose from. If you have any questions, please leave them in the comments below or feel free to contact me directly. I'll be happy to help.